so do you guys have any questions about last week's lesson, or about the homework, or about the exam that's coming up in your future before we move on? Yeah.
Can anyone, go into the exam in December?
Yeah.
So as long as we sign up. Okay.
Yeah. Oh, if you haven't already, send me via email just your name if you plan to take the December 17th exam. Yeah? Don't forget, the deadline for that is coming up real soon. That was on video. Okay, so let's continue talking about equities. Okay, so I hope you guys are getting a feel to what the structure of the course is all about. We're going through the basics, and as we're going through the basics, I'm giving you real life examples. But the most important thing is to always think in T accounts, right? Because if I'm going to teach you something now about how equities get issued or traded, you should always be ready to draw up a little T-bill for me over the before and after to prove to yourselves first that you know what you're talking about, because otherwise it's really just in the air. And the whole point of this course is to bring things from the theory and from the talking and from the mumbo jumbo into facts. Okay? And there's only one type of facts in finance: accounting. Okay? Equities. So I always assumed that you guys knew this very basic concept of assets, liabilities, and equities. Just as a reminder, you can have on your asset side, say a building, and let's say you've issued, you've borrowed a senior mortgage, okay, a mortgage which has seniority over any other debt in order to finance the purchase and construction of this building. And let's say you've also borrowed some money from another kind of private lender, and that private lender has agreed to take a junior position relative to the mortgage lender. Okay, and this means that in case you were to default and the lenders would seize this one property that you have and they would sell it at an auction, then whatever cash proceeds, the liquidation, this is another use of the word liquidation, when you put things in auction and you liquidate the company, fetches, then first the senior debt will get repaid, and only afterwards, if there's anything left, the junior debt will get repaid, and whatever is left over that is yours as the shareholder of the company, as the owner of the company. Okay, so equity is kind of the most junior claim. It's whatever is left over. And it's also associated with ownership over the company. And yeah, obviously the junior debt will be at a higher interest rate than the senior debt because it's just that much riskier, it's just arithmetics. And as a logical consequence of that, equity, when priced correctly, is expected to give a return which is even higher than that of junior debt. Okay, it's just logically like that. Now, it's not always the case because equity is kind of the leftover. Sometimes it can be zero. It can never really go to negative. You just liquidate it because of the limited liability, then it's capped at zero. But when it's priced correctly, then maybe you're making 2-3% when investing in senior debt. Maybe you're making 5-6% when investing in junior debt, and maybe you're expected to make, if everything go kind of on average, 10 or 12% on the equity claim. Okay, and that's more or less what you see when you look at broad averages of these asset classes. Any question? I thought I saw a raise a hand over there, or no? Okay. So, yeah, the basic definition. Now, shares is when this equity claim is sliced into shares, okay? So all the shares in a given class of shares, and we can discuss soon what are different classes of shares, have the same rights, and you just slice them up so you can buy a fraction of the equity. You don't have to own all of it. There's three main rights attached to ownership of shares. One is to attend and vote in the shareholder meeting. Okay, this is something that's completely overrated. As a shareholder, especially of a public company, you have no say whatsoever. Because if you go to the shareholder meeting, yeah, maybe they serve wonderful, meatballs in tomato sauce, and that's great. But the questions which you're asked to vote on are already pre-chewed, just like the meatballs. They're already pre-chewed, and you have no real choice other than to say, okay, well, because if I say no, then it's already been predetermined, kind of. So it's usually meaningless, the questions that you get to vote on the general meeting, especially when I'm talking about publicly listed companies. The main right attached to owning shares is the proportional right to participate in the dividends and the proportional right to participate in whatever is left over in case this company gets wound up or liquidated. These are terminologies. Okay, I don't know why they say wound up. I would think they would say wound down, but they say wind up. And why would they say liquidated? Again, this concept of liquidity is very confusing, very abused, but it always has to do with how easy it is or when you convert an asset into cash. Okay, when you close the company, then you sell all the assets, you pay back all the debts, and whatever is left is the cash that you give back to the shareholders. Dividends are paid out of profits. That's important to remember. I want to discuss the difference between a dividend and a capital return. Okay, what's a capital return and what's a dividend? You might think that anything that comes out of the company's bank account and goes to the shareholders is kind of a dividend, but the concept of capital return is to return a previously contributed capital, okay? And then the difference is in the tax treatment. A capital return is usually tax-free. Everyone should be kind of happy with the tax-free. Let's just do everything as a capital return. No, but the definition is quite simple. Let's say we group together 10 units of money each, and we contribute it to this newly formed company. So there's 40 money that's being contributed, and let's say we've made $5, let's say, of profit after a year, and this was just a one-time deal that we made. We made this company just for this one deal, and we sold it for 5 profit. Then when we liquidate it, we return 45 to the shareholders. That's us 4. Now 40 is tax-free because it's just like when you make a deposit into a bank account and then withdraw it. When you withdraw it, you don't have to pay tax on it. That's the concept of a capital return. It's the money you've put in, and when you take it out, you don't need to pay tax on that as if it's a profit. But on the 5, that's a dividend which is taxable. Okay? Dividends reduce the company's equity value, obviously. They reduce the cash assets by the amount of the cash dividend. A dividend can also be, in the form of other assets. It doesn't have to be cash, but usually there's a cash dividend. Okay, the question that why do companies have to have positive equity? What's the problem with the company having negative equity? And firstly, it's possible for a company to have negative equity, and this would be just temporary, and maybe nothing would happen. But this is not a sustainable situation, cannot stay like this for a long time. First, the equity provides protection for creditors. Now, creditors is more than just a bank or a private lender or the bondholders lending money to finance this company. It can also be suppliers. Okay, if I'm supplying some goods or services to this company, it will often be on terms of credit. Okay, so I would supply first and only get paid after 30, 60, 90, or 180 days. And that would just be standard practice. Whenever you trade with a company, it's usually done with some sort of kind of bilateral trust and credit. And if they go into default, then maybe they can't even pay me back, and I'm a supplier. So it's creditors is not just lenders, it's also suppliers and also employees, right? Employees get paid usually at the end of the month. So what about if you worked for 29 days in that month and then they went bankrupt and then you didn't get paid for that month? Now often you wouldn't get paid for several months because you're still working and there's one salary that's delayed and then you get them more time, another salary, but maybe you lose 1 or 2, 3 salaries. But usually the employees have the most senior claim against the company that's going into default. So firstly, the employees need to be paid, and then maybe the suppliers, and then maybe the debt holders. But of course, all of that gets really scrutinized if indeed the company goes into liquidation and default. So, yeah, if the company has negative equity, that means that it has more liabilities, money that it owes, than assets that it has. So there is this problem that maybe they can never repay what they owe. Okay, so that's called insolvency. And this is a problem even before the company becomes insolvent. This can be a problem because of doubts being expressed about its solvency. All right, so even if a company is not yet fully insolvent, it's not really exactly yet the situation, but maybe suppliers say, well, I don't want to work with you, I don't want to give you these basic materials unless you pay cash up front, or maybe at all. And maybe other lenders are not willing to renew their loans or give new loans until this issue of the doubt around the situation in this company is resolved. And then this could lead to a situation of illiquidity. Again, this word, liquidity, in this case means the inability to pay back loans due now. Okay, so let's say the company has a lot of assets, but these assets are long-term properties such as buildings and or plant or other long-term assets, which cannot be easily sold for cash and do not generate enough rental income or other cash income in sufficient amounts to pay back loans as they come due now. Okay, maybe you took a big loan and its maturity date is now, and you as the company were thinking to roll this over, to extend this, or to get a new loan and pay back the old loan with a new loan, but you couldn't, just because of rumors about your solvency. So and then this can push you into insolvency. So illiquidity can push you into insolvency, even if in the long term your assets value is high enough. Okay? So this can push a company, especially financial institutions such as banks, could be an extremely acute problem when they cannot meet their ongoing, in the present, right now, liabilities as they become due, and they're forced to sell their long-term assets in what's called a fire sale, okay? They just sell whatever assets they have for whatever amount they can get, okay? And that's often a price too low, because if you're trying to sell something in a hurry, right, think of your house. If you're really trying to sell this from today to tomorrow, then you're not going to get the same price. Maybe you take a 10 or 20% discount on a house. And with financial assets, now this is often what happened in 2008, 2009, the time exactly when these financial institutions got into this illiquidity, to the state where their liabilities coming due right now cannot be met with cash because they're not generating enough cash, then they had to sell these other assets, and this was exactly at the time where nobody else was buying these assets because all the other financial institutions were kind of in the same situation. And then the haircuts or the discounts that they had to sell these assets for were very deep. Okay? And then this can be the end of the company or of the bank, because if they now just sold their assets for 30-40% discount or enough of their assets, then they're locking in the loss, and the whole, maybe they don't own the building anymore, so the whole thing can get out of hand. So illiquidity can lead to insolvency, even if all the company or the bank needed was a little loan to stay afloat, and in the long term everything would have worked out. And that's why it's always important to think in kind of about this issue. Okay, and also the regulators worldwide have recognized this long time ago. This issue of the ability of a financial institution to pay its right now debts, okay, its debts as they come due, and in the long term, its solvency and its capital situation. And the things are related. Okay, and try to read that article by Thomas Jordan, who was the head of the central bank in Switzerland, about why central banks don't face the same problem. Okay, well, they can never be forced to sell their assets. Well, shortly, maybe by now you understand, is because their liabilities are primarily base money, okay, the monetary base, and this is kind of the ultimate liability, okay, because, or the ultimate asset, because you can only redeem it for itself, right? So if I'm a bank and I have a deposit with a central bank and I want to redeem it, then I just get a little note that's called, a bank note that says that I still have it. So you can't really take it and convert it to anything else. You can sell it, but then someone else has it. Okay, that's why the central bank can never be pushed into a situation of illiquidity. And that's why it's also okay if sometimes they go into negative equity. Okay, you have to think about it. That's really important. Book versus market values. Any questions, by the way? So far? Has anyone ever traded stocks here? Yeah. Okay. What made you buy or sell?
Well, I bought when the market was down.
You bought because it went down.
Yeah,
Okay.
and UBS when
Okay,
in
UBS
financial
shares.
crisis,
Okay.
and I saw the increase.
All right. What did you buy?
I bought from my ex-firm, Flagship, because it is known that it goes down during the year and goes up to like 320, 350, and I bought myself at 240.
What is it? Which share is it?
Flagship Vermögenszentrum.
Oh, okay.
It's a broker, bank, something.
It's Reichmuth, it's called. Reichmuth? No.
No, Flagship Vermögenszentrum. It's a holding.
All right, don't know it. But you done well on it?
Yes,
Good.
20%.
All right. Any other person here bought some shares? Nobody's gonna. Yeah. What did you buy?
different, like Lonza, you know Lonza Group?
Lonza Group? No.
It's a chemical stuff.
Chemical? Okay, alright.
What did you buy?
I have all of it. I have all of it. I have all the shares. I have all the shares. We're gonna reach that. So the book value is the accounting value of anything. There's the book value of an asset, the book value of liability, and the book value of equity. Okay, so that's the accounting value, what goes in the accounting books. And that's often different from the market value. Okay, so often in a book of a company, let's say it owns a building, then the value of that building will be inputted into the accounting system as at its historical cost. Okay, what it costs to buy it or to build it. But you know, as time passes, the value of this building can go higher, and then the market value of this building, and as a result, the market value of the equity of the company will go higher than the book value. Okay, and that's the difference between book and market value. Sometimes a revaluation prior to sale of the building is possible if with evaluation by a third party. Okay, so that's usually the case with real estate. You can only revalue it to a higher or lower price if there is an official valuation conducted by a licensed evaluation company. Okay? And then the market value of shares is the price between buyers and sellers. And again, this is either private transaction or on an exchange. Okay, when people buy, they can exchange the shares in a company even if it's not listed on any exchange. Valuation, how do people come to reach what's the right price for a company? Okay, this first one you guys probably know, it's called discounted cash flow. If you go back to the last lecture, there was a little formula that you take the future cash flows and you discount them at an appropriate rate of interest, and you reach an estimate of the price. Now, this is as far as one should go in his career as in finance with these things. Okay, because there's this tendency of young people to think that, oh my God, there are so many ways to value a company, there's so many ways to estimate what the correct discount rate should be, to estimate what the right cash flows are, and we can become so good at that and so knowledgeable as regards different little details about each company and about the different methodologies possible out there that nobody will be able to match us, and we will get a good job and make a ton of money in the bank. And the reality is that valuations are subject to huge variance. Okay, even independent valuations can vary widely, and this leads to valuations done on paper to not have such big weight as you might think as a beginner in this industry. And so you may not want to dedicate your entire lives to Excel spreadsheets to be able to do valuations, because the junior in the bank or wherever that's doing the valuation is not really the person taking in the big bonuses. Okay, the person taking in the big bonus is the guy that's managing the deal, is the guy that's managing the relationships between the client, which would be, say, a company that wants to issue its shares, and the higher ups in the bank. Okay, so the person that can decide, that's managing the team, he would be just hiring some analysts to come up with a valuation, and often it would be, well, what did it come out? Make it a little higher, make it a little lower, because if I'm running this show and I have investors on the one hand, pension plans, institutional investors of various kinds, wanting to buy shares of Ferrari or some other company that gets issued for the first time, then I'm in the middle between my client, which would be the company that came to me in order to sell its shares on the stock exchange for the first time in an IPO. We're going to talk about that in a second, and the institutional investors. And then the question is, what is the right price for these shares, which is a direct function of what is the right valuation for this company. And this is a game of negotiation and expectation. And often the person doing the valuation is just gonna, come up with a number which is close to what I tell them because my feelings go this direction or that direction. Okay, so valuation is always part of negotiation. Okay, because valuations are anyways extremely sensitive to whatever assumptions you make there. So you can reach very wide ranges of valuations for a given company. Okay, so it's again not it's just like macroeconomic theory. The micro side of it is valuations, where people take these things often too seriously, and really, what the real world is much more subtle. Finance is a lot about negotiations, okay, and that's kind of interpersonal skill, and the numbers, they always are a part of this negotiation, but they are never the driver, okay. The next valuation methodology, if you can call it that, is the multiples comparison. It's kind of a shortcut methodology. You take some measure, some metric, sales, or often it would be EBITDA, it's called, earnings before interest, tax, depreciation, and amortization. It's a way to kind of get through from the noisy one-time items that are the net earnings to a kind of a more sustainable metric of profitability called EBITDA. Okay, and you would take this metric for this company that we're valuing and just say, oh, within which industry this company is, metal mining, the average is on this link. Actually, this is quite an important link, is so and so, and 12 or 10, and then its EBITDA is so and so. We give that a multiple of 10. Okay, so that's kind of shorthand, and that is quite common practice. This is really the common practice. So this price to EBITDA methodology to negotiate the final price, okay, it's methodology to negotiate the final price between buyer and seller, is quite common practice. Have you heard about this? Okay, good. Any questions? All right. Private versus public shares. So almost all companies start as private companies. So let's say there would be 1, 2, 10 shareholders. Usually it's 1, 2, 3, 4, 5 starting a company, and then they can grow, and then they can add shareholders. And it's not listed to trade on any exchange. Okay, the share ownership is we're gonna get in a second where shareholding is kept. The information of who owns how many shares, that needs to be kept somewhere, and we're going to discuss that. But when a company gets big enough, there is the incentive both to investors and to the company to list the shares to trade on an exchange. Okay? So again, to kind of highlight to you that there are vast numbers of companies out there. Some of them are very large, which are held privately, which you never heard of them. But then the tendency is still by people to kind of overly focus on the listed securities part of the universe. They tend to think that the stock market is everything, okay? And it is a large part of the economy, but there is another quite large part of private companies that don't really trade where you can see it. Sometimes shares exchange hands between private hands, but you don't really hear about that. A listing, that's the term, means allowing the shares to trade on an exchange. A listing is a complicated process. Literally, you can go on the New York Stock Exchange or the SIX, Swiss Stock Exchange, and you would find a link, listing, and there would be a checklist. Just do Google checklist for listing and read all that. And it's possible to do. So, but that's because companies do that all the time. And but it's quite a long checklist. And the point is that maybe the checklist is not that long and not that unusual. All these things you anyways need to do at different stages of operating a company. But I guess the scrutiny that your financial reports and your prospectus are evaluated is highest, okay? And that's because the exchanges have kind of a national responsibility, mandated also by law, to make sure that the quality of the information that is disclosed to investors is sufficiently high, okay? Finance is a lot about alleviating asymmetric information. So the companies, directors and managers would know more about the profitability and about the business of the company than outside investors, okay? And that is a problem, because if it's a good company, maybe the insiders know that, but the outsiders don't. So the investors are only willing to pay a low price, but the company is only willing to sell those shares for a high price, so they never meet. And vice versa, if it's a bad company, but investors don't know that, then the investors are willing to pay a high price, and the company is willing to supply whatever amount at that price. And then the investors realize that, wait a minute, if they're selling to me, then it must mean that it's a bad company, then I don't want to buy it all. A person even got a Nobel Prize for this. This is called the lemon problem. Joseph Akerlof got a Nobel Prize for this concept, and this is very true in finance. And this asymmetric information leads to a no-deal kind of zone. And exchanges are all about alleviating this asymmetric information by making sure that the quality of the disclosure from the company to investors is highest, so that investors can make an informed decision, so that a market forms and people trade. And the most important and hardest thing to do, and really everything is contained in this, is to convince investors to buy your shares. Okay? When you go on a listing, it's not like, bam, you get, sometimes it's like that, but there's a lot of background work to find those investors who are willing to buy your shares. Okay? And preparing all these documents is just kind of the base requirement to get that, but then starts the real work, which is to convince shareholders to buy these shares. Okay, new versus existing shares. And this could be an exam question, okay? You might want to listen, because there's a T-bill here, and it's kind of a profound difference that people don't fully understand. So if I'm an existing owner of a company, a private company, then maybe for some reason I want to sell my shares to you or you, and we agree on a price based on a valuation. We agree both on a price. I need the cash to do something else, and you want the company because you believe that you can do something good with it and get a good rate of return on your capital. So we agree, we shake hands, and we make it happen. You have to remember that the money goes to my private bank account. And now you, the buyer, get the shares. So you now control the company and you now get the dividend and I get the cash. Does this mean that the company have now more cash to invest and to increase its business? Absolutely not. Okay? The only way for a company to increase the cash it has in its coffers, that's what they say in the media, the cash they have in the bank account, is if they sell new shares. Okay? So I would issue new shares to you. Now, instead of owning 100% of the company, I would own only 50% of the company and you would own the other 50%. Okay? And that cash that you paid for these shares, newly issued shares, goes into the company. So now even that I own, instead of 100% of the company, only 50% of the company, hopefully we did it at a fair valuation such that the company is now worth twice as much thanks to the cash that you've now injected into the company. Okay? So there's a T-bill there, I hope you guys can imagine it. And yeah, then the cash becomes property of the company. And then I'm the manager. I can, on behalf of the company, buy another building, increase our plant, go into another country and hire some people to sell our product. And we can do everything that we dreamed of. But that's a huge difference. That's a huge difference. And you would be amazed at how many professionals talk about this interchangeably and making errors, basic errors, not understanding the difference between existing shares and new shares. Okay, there's a big difference. Yeah.
So if a company wants to create more new shares, do they have to consult the previous, like the existing shareholders, because then their individual shareholding is going to be worth less, it's a smaller percentage of the company?
Sure, that's a very sensitive part. We're going to talk about it in this lecture real soon. And often there would be an amount authorized in the constitutional documents of the company. We're going to talk about that exactly. That would be a certain amount that is allowed to be issued, of which a certain amount was actually issued. So that SLAC can be issued without prior approval of the existing shareholders, but above and beyond that, there might be a requirement to get shareholder approval. But even before that, if this is a strategic enough decision to bring in this outside investor, it can be in another clause saying that existing shareholder approval must be sought before the company is allowed to do that. So the answer is, depends what you write in the constitutional documents. And the more sensitive it is, the more privately held this is, the more the interest of the existing shareholders is the highest, then the more restrictions will be put in place to begin with to make sure that everything is done with consent. Yeah.
What do you think of the way that the Snapchat founder made his IPO, like he issued only like non-voting shares?
We get to that, yeah.
Okay.
I don't know, I haven't watched closely, but I heard it was a big flop, was it?
I didn't follow it.
Okay, I didn't follow
I
it.
just heard that, you know, he issued the shares and he kept all the.
All the voting. We talk about that in a second. The IPO is often a mix of selling shares of the existing owners and issuing new shares. Okay? So, one reason for the existing shareholders to decide that they want, together with management, decide that they want to list the shares on an exchange is because maybe they think that it would be easier for them to sell some or all of their shares to the public and at a higher price than it would be for them to find private buyers. So that's one incentive, which would be to sell their existing shares, but maybe an even more predominant reason for people to list their shares, for companies to list their shares, is to issue new shares to new buyers. Okay? Because then they are able to substantially increase the scope of their activities. So it's usually a mix. Now this IPO is a big deal. Okay, it's a once in a company's history. Usually, it's a once in a company's history that they do this IPO, initial public offering. This is that stage where they decide to list their shares, and often it would be in order to sell existing shares, but also to issue substantial amount of new shares. Now, it's all about access to investors, okay? The stock market is not some magical thing that you get money out of, that people just click mindlessly and buy new shares on the IPO at whatever price they're told, okay? There's a lot of thought that goes behind it, and the big money that is actually purchasing these shares is institutional money, okay? So then it's a lot of money, a lot of capital is at the hand of a few institutions. Okay, and then they have every incentive to really sit down and think and negotiate the right price, as opposed to just a small investor like you or I, that we would just buy, you know, the whole market, and then we're buying just a little small amount from every share, assuming that there are other bigger players who done their thinking and brought the price to be fair. We're going to talk about this concept of fair pricing in the markets. It's called the efficient market hypothesis. Some person got a Nobel Prize for this too, and we're going to talk about this quite briefly, maybe a bit in 2 or 3 lessons. And it's all about access to investors. So companies listing their shares on an exchange almost always need the help of a financial institution with links to investors. What do these Goldman Sachs and Morgan Stanleys and UBS of the world, what do they have that Apple doesn't have? Or maybe Microsoft, when it listed first time, what they didn't have is access to investors, okay? That's why companies go to these investment banks or to the investment bank division of a larger bank holding conglomerate. And it would be for access to investors. Now we're talking pension plans, sovereign wealth funds, mutual funds, and hedge funds. Okay, so all of these would already be clients of the investment bank for different things. One of them would be in order to have access to their kind of pipeline of newly issued shares of new companies going in the IPO. And then if I'm a hedge fund manager, then the investment banker, I would look on their website when a new IPO is coming, and when a new IPO is coming, I would call him up and try to get some information from him about it and decide if I want to invest at an early stage or at the IPO. And the IPO price, okay? How to set the price at which to sell the shares for the first time. Okay, it's a private company. Okay, it has all these assets, it's generating profits. Maybe it's even still generating a loss, but let's say it's generating profits. How do we value this company? This company doesn't have a market, a public market where people are already buying and selling. We're talking about putting it on the market first time. So, and that's a very delicate issue. Okay, this will determine how much dilution takes place to existing shareholders in exchange for how much cash. Okay, so the price is everything. If it's at a high enough price that we're diluting shareholders, existing shareholders will be happy about it. If it's a too low price that we're diluting these shareholders, then they're not going to be happy about it. So this is a very delicate art of negotiation between many different parties. Okay, there's a process called price discovery. Okay, where let's take a break actually. this game of building a book and finding investors for a newly issued shares is rewarded with about 4 to 8% of the proceeds in fees to the investment bank. Okay, if you think that's a lot, good, because it is a lot. It's very profitable. Investment banking is very profitable. And of course, not everyone can do it. You need to be a large financial institution with already relationships to all these large investors. Okay, you can't just do it as an independent. But still, there is such a thing called boutique investment banks, which would help small companies list on small exchanges, or raise or list a bond, and so on and so forth. Price swings on IPO day. So after the price for the IPO is set, okay, this is the price at which shares will be issued, newly issued by the company, and those investors at the IPO price give out the money to the company, okay, and that's done at a certain price. After that, immediately after that, those shares begin to trade freely in the secondary market between existing investors and other investors, okay, and then that's the first day of the chart that everyone knows. Okay, there was a lot that led up before that. The company was profitable and it existed maybe for a long time before that. But there's one day where the chart that we all know starts, and it would often be the case that all this price discovery and how to set the price would be significantly off. And then the shares would start trading on the first day. Economically, nothing really changed between the day before and today about the fate of this company. But the investors that agreed to buy at the preset IPO price, maybe they find out that later on that day those shares are trading 20% higher or 20% lower, and that wouldn't be out of the ordinary. That would be a price swing of between 10 and 30% on IPO day. That would be something usual. So I don't know what happened with Snapchat, but if I remember correctly, it was a flop. It was an up and a down. It was a flop, right? So sometimes the book runners, the investment bank manages to get a high price for the company by, making a lot of noise about it, and then institutional investors sign up to buy it at a high IPO price, but then when it's allowed to freely trade, the price goes down.
How many percent of the shares, like the newly issued shares, are actually sold before of the IPO, and how many usually are traded like on the exchange the first time? Or are all shares usually sold in advance of the IPO?
No. Many times the existing shareholders will maintain ownership of the shares. So if I'm listed, if Elon Musk is listing Tesla, then if he had 10% of the company before, and then afterwards he has maybe 3%, 5% is kind of dilution because he sold the same amount of existing shares he issued new. Then instead of 10% now he owns 5%, and then maybe just 2% additionally he sold. Maybe he didn't sell anything. Okay, but it's almost always the case that a substantially less than 100% proportion of the total shares is trading. So the other maybe 50 or sometimes more percent of total shares that are issued would be held in private hands. Potentially they could also be sold on the exchange because it's the same thing, right? So it's the same share, and they can be sold, but usually they're not. They're just held for long term. And there is some reporting requirements for people that have more than 10% shareholding in any company. They're called insiders or large shareholders. When they sell or buy, additionally, that needs to be disclosed to the Securities and Exchange Commission or FINMA or wherever is the regulator. Okay. Okay, going back to the basics, let's see how this whole thing starts. The constitutional documents, every company must have them, are usually divided into two. It's not necessary that they will be divided into two. We could have just one document, but it is divided into two documents. The primary document is the Memorandum of Association. It's usually just a few pages long, and it states explicitly the name of the company, the registered address of the company, okay? The legal type, whether it's a partnership or a company limited by shares. A company limited by shares is what most of us know. The limitations on the business activity, they might say in the memorandum already there that this company will do this type of business and is prohibited from doing that kind of business. Sometimes they want to clearly define that. Most times it will be open to just anything. If it's a bank, then usually it will be stated that this is a bank that will take this banking activities, borrowing and lending. It would be defined the different classes of shares, and we're going to discuss quickly what are different classes of shares. Some have voting rights, some have no voting rights. And the number of shares authorized and then fully issued. Okay, usually it would state the number of maximally authorized shares. So this would be usually quite a high amount, and of which the company management is allowed to issue up to the authorized amount without seeking pre-approval from the existing shareholders. Okay? And then the Articles of Association would be a lengthier document containing more detailed and more nuance on the different aspects of what this company is all about. Okay, what the roles and responsibilities of management is, what the role and responsibilities of the directors are, how shareholder meetings should be conducted, under which circumstances existing shareholder pre-approval must be sought. Okay, this would be written usually in the articles. What is the dividend policy? They can say that if we make 100 profit, then we get 60% of the profit. We're gonna distribute to the shareholders. Okay, so this would be written in the articles. And this would be many times be important for new investors, right? If I'm investing in a company that's, especially if it's kind of a small or medium-sized company, and I'm injecting equity capital into it, in the hopes that one day it'll be so big and make so much profits, then I will get the dividends, then I kind of want to know that when they make profits, then they will actually pay dividends and not just keep reinvesting it or take it as a salary. There could be limitations in the articles on what the salary of the CEO should be, from the directors should be. Okay, that you can put limitations on that in the articles, and that's a good thing to do. It's a good thing to think about as an investor, right? All of us, when we started, okay, and you still now, when you invest in the stock market, you just kind of take for granted that if this company is going to do well, then you're going to get a dividend and the price is going to go up but there is legal documents that guarantee that the dividend will be paid and not just the money, the profit's going to be drained out by management in the form of higher and higher bonuses. It's theoretically possible that the richer the company gets, the more profit it makes, then the CEO just simply takes more and more bonus, and then you will never see any dividends for your equity investment. It's possible, it's happened, wouldn't be a first. Okay, additional documents. There might be an even more kind of specific document called a shareholders agreement, which, if we want to have kind of very specific to our setup, let's say we start a company and I'm gonna be majority shareholder and each of you will be a minority shareholder, and then there are certain situations where you can, be taken advantage of as a minority shareholder, or that you can hold me back as a majority shareholder from doing what I want. Okay, so a shareholders agreement would be an additional agreement that we might set out exactly if, say, we were to be successful and another person or company wants to buy us out, then a tag along means that you as minority shareholder would have the same, I would not be able to sell just my majority shareholding stake to another investor without that investor giving you, the minority shareholders, the same deal and allow you to get the same deal. Okay, that would be tag along, it's called, or drag along, meaning that if I want to sell, then you guys have to sell as well. You cannot hold me back. Okay, so, and all sorts of mechanisms to resolve deadlocks in case that we disagree and we can never find a middle ground to do what I want to do or what you want to do, then we would specify the mechanism on how to resolve this, either by vote or by another mechanism, that this would be defined usually in kind of an additional agreement we call a shareholders agreement. And sometimes there's also a prospectus or a private placement memorandum. That's usually a disclosure to passive investors. In the fund industry, this is every time a company issues either a bond or equity or shares, even if it's a private company, there needs to usually be either a prospectus or a private placement memorandum, which is additional disclosure to minority and small shareholders. Okay, authorized versus issued, we've discussed that. Par value is a bit of an arcane concept, you can read about it, but just remember that par value when it comes to shares is kind of an arcane concept. It's not really relevant anymore. You can have different classes, so Berkshire Hathaway, a long time ago, management decided that they want to have two separate classes of shares, one for the kind of long-term holders, big institutions and wealthy individuals that buy for the long term, and another smaller one for retail investors that often buy in and out. And Warren Buffett then he said that he doesn't want the shares to be too cheap so that people with just $1,000, $2,000 wouldn't be able to buy in and out, because he didn't want the volatility in the price that's associated with retail investors. This is what was in his mind at this time. Maybe it's right, maybe it's wrong. But he decided to have two classes of shares, and they participate differently in the dividend of the company, okay, and in the profits. So it means that the Class A gets 1,500 times more per share from the dividend, okay, and that dictates the ratio between the market price. Okay, so the Class A is traded roughly 1,500 times more expensive than the Class B, just because it receives 1,500 times proportionally more dividend. Okay, and there's also an even starker difference in the voting rights. So the Class A have 10,000 times more voting power than the Class B. Okay, now this voting power really doesn't mean hardly anything, because the decisions of what to invest in as Berkshire Hathaway, that's done by management, and almost none of their investment decisions really need shareholder approval. And the annual shareholding meeting is more kind of a ceremony. There's no real decision made by the shareholders. But yeah, so there is some negotiation between the usual proxy companies. I didn't put this on here, but there are maybe 3-4 large companies that they kind of do the research on the companies and decide whether they're gonna say yes or no to whatever questions at the shareholder meeting, and in particular whether to approve the directors and executive management's compensation packages. That's always a source for discussion. And there would be negotiation usually between the company and these kind of institutions, there's 3 or 4 of them, that they vote on behalf of most other investors. So all the mutual funds, the hedge funds, all these institutional investors, they vote. And also when you have shares in your brokerage account, Swissquote or Interactive Brokers, you never were asked to vote, but voting was usually done on your behalf. Okay, so Swissquote or Interactive Brokers, they voted on your behalf in accordance with the recommendation of these 1 out of the 3 or 4 proxy companies. Okay, so these 3 or 4, one of these would do the research and they would recommend either to vote yay or nay on the compensation package or on whatever else is put up for a vote at the shareholder meeting. And then all of the mutual funds, all of this, they would be required by their own kind of set of constitutional documents just to vote in accordance with what was the recommendation of this institution. Okay, I didn't put this on there, but again, it's another perfect example for a natural monopoly in finance. Yeah.
If I didn't agree with the vote they were giving for my 10 shares, could I intervene and say that I have a different opinion and
Yeah,
give my
yeah.
vote to the 10 shares?
Yeah, so I don't know if Swissquote will allow you to do that, but some of them would allow you to do that. Some of your brokers would send you a letter before the annual general shareholder meeting, and you'd be allowed to kind of override the default and go and attend the shareholder meeting and eat as many, these meatballs and tomato sauce as you can, and vote yay or nay. What's the point even going if you're gonna vote yay? You're just gonna go and vote nay.
But is there like a minimum amount of shares
No, I
percentage
think
you have
no,
to have? Because
no.
I never got a letter.
You never got a letter. That's probably your broker didn't ask you, but
The broker is UBS or was?
okay. So yeah, I guess they don't ask you, but there is no minimum. I think from the first share, you're allowed to attend the shareholder meeting. Maybe you should buy a UBS share. They have the best meatballs.
That's true.
Yeah. Yeah, so different share classes, ordinary shares, different par values. Usually the par value defines how they participate in the dividends. So just like Warren Buffett did with Berkshire Hathaway, non-voting shares. So many times shares would have no voting rights attached to them. And then the voting rights would mean as regards to the daily to management. Okay, still, even if no voting rights class of shares, let's say if I'm the manager of the company and I decide that I want to worsen the conditions of the no voting share class. The no voting share classes were allowed to participate in 1% of the dividend or 10% of the dividend. And I'm the manager and I decide to change that all of a sudden. They have no voting right. You would think maybe they cannot vote against that. But changing to the worse, the rights attached to any class of shares usually requires the pre-approval of 75% of that class of shares, even if it's a no voting class. Okay, so even no voting shares is no voting on what? Okay, if you're trying to really worsen the rights attached to their shares, then yes, they do have the right to vote against it, and you do need to get their consent. Okay, so this whole voting thing is, for public companies, usually loses its value. It becomes completely irrelevant, this whole voting thing for public companies. By the time the company gets so large, the shareholders have no say. The only say they can is to reject the compensation package, because that's usually by law required to be put up for a vote, either to approve or reject the compensation package for senior management. And that's especially sensitive with the banks. So the banks are always kind of a bit careful with how much they push higher. They always say, oh, the other banks are also paying. So therefore they try to convince these institutions, these 3 or 4, that recommend to all other investors how to vote. So this would all happen behind the screen, okay? So by the time that the compensation package is put up for a vote, this is already post-negotiation and post getting the approval kind of tentatively from these voting proxies. But for smaller companies, private companies, then voting rights attached to shares can become more meaningful, especially if a shareholder agreement specifies that a financing decision, whether to finance or not, or how to finance, whether to take a loan, what to invest, if that's explicitly stated as something that requires the approval of the voting class of shares, then there's purpose to the vote. It's usually with private companies that has more meaning. Okay, you can read the rest of it. Share ownership record. Now we're getting to the T accounts again. I see some smiling faces that we're getting to T accounts. Where is the record of share ownership kept? Okay, you guys never doubted that those Apple shares that you bought on your Swiss quote Konto are actually yours, and when they pay a dividend, you will get that cash to your account. You never doubted that this would happen. You just kind of assumed that this would happen because the world is full of good people, and good people do the right thing. And maybe that's true, mostly, but there is a mechanism to keep track of who owns how many shares. Okay, there's a mechanism for that. And just like the ownership of money, just like the ownership of any asset or liability, it's kept in an accounting ledger that you can easily also in an exam describe as a T account. And it's called the shareholder registry. It's just like an Excel spreadsheet that has a name and the number of shares, and then at the bottom you have the total number of shares issued, and that's how it works. Okay, it must be kept by law, by the company. Okay, this is a law. So if I start a company, I registered it with the company's register, the Handelsregisteramt. It's recognized. I am obliged by law to keep track of who owns the shares of this company. Now, whether this shareholder registry, and sometimes I have to file the ownership with the company's house. In some jurisdictions, I don't even have to inform the company's house who the shareholders are. And yet in some other jurisdictions, I have to inform them, but they may not make this information public. And yet in other jurisdictions, everything is transparent, that I have to, by law, tell the company's house who the shareholders are, and the company's house then makes this information public. So depending, in Switzerland, the shareholding is not public information, and then I'm not sure if you even have to inform them on an ongoing basis. There's different places in the world where you can keep more of your privacy, and of course, wherever you have privacy, you have had in the past money laundering, and the world has changed such that all these places have been kind of blacklisted, and so are usually find it very difficult to open a bank account, and basically that takes away the whole purpose of being private, because you can't do anything with the money. But still. Transacting in private shares, buyer and seller can simply agree on a price and exchange ownership of the shares, and this would be reflected in the company's shareholder registry. Bearer shares is something that is again losing its popularity because of regulations and laws prohibiting the use of this. It used to be that this would be the shareholder registry of maybe Berkshire Hathaway's. 200,000 shares are owned by Mr. X, 200,000 owned by Mr. A, and 150,000 are to the bearer shareholders. That means that it's a physical certificate that identifies the owner, but without a name. So it just means that if I own this, because I bought this from you and you bought it first time from the company, your name was never registered, and when you sent it to me, my name was never registered, but then when they pay a coupon, they announce it, and then I send someone that it's clear that it's just a messenger and to deliver this, and he takes the coupon cash money for me. So this used to exist. This is called bearer shares. You also have bearer bonds, but obviously wherever there's anonymity is going away out of this planet. There's hard to stay anonymous. Yeah.
When you have shares, I mean, I as a private person who has little shares,
Yeah.
I never get the shares myself, even though there are maybe bearer shares, because normally the bank holds them. Not important
Right.
who is the holder.
Exactly. So this is what I want to discuss with you, because it's the same exact mechanism for base money, that everything is kept in custody on your behalf. So if you're banking with JP Morgan, you have a securities account with JP Morgan or a Swissquote or any other bank, in the company's shareholder registry, there would be JP Morgan appearing as owning 1 million shares, but it's well understood by everyone that JP Morgan is holding these shares in custody as a nominee in favor of you and you and you and you. Okay? So it's exactly like base money. It's exactly just like money. Only much less problematic, because these shares are really just held in custody for you, and the bank is not, this was recently changed, the bank is not allowed to lend these shares as a securities loan or do anything with these shares. It used to be possible for them also to lend the shares and make a profit. You didn't know that.
You mean like leerverkauf?
I don't know what's leerverkauf, but
Short.
yeah, not short selling them, lending them for short seller to be able to short sell them. Okay? And they're not allowed also to borrow money. They're not allowed to borrow money using your shares as collateral.
So if you have a T-bill, do you have like the market value on your balance sheet, or do they have, for example, JP Morgan do they have the, assuming it's a new IPO, do they have the market value on their sheet, or is it?
So on their balance sheet, this does not appear. This does not appear on the balance sheet that you read in their financial statements, because this, by law, and this is a very relevant question, this is really truly a custodial, purely custodial relationship. So it's really just that they're holding this on your behalf, and it's not their property, it's your property. And then they're allowed to take both the asset and liability off balance sheet, and it doesn't appear. Of course, it is in some Excel spreadsheet. They need to know that they hold it for you, but it's neither a liability or an asset in the accounting sense, in how you present it. But of course, it is both an asset and a liability, effectively, because they hold this in custody for you. Okay. So this is a minute kind of detail. Okay, but potential, and then let's get to the Central Securities Depository. So when a company lists their shares and even if they're still a private company, but it's mostly used for public companies, they would opt for this shareholding registry to be kept with the Central Securities Depository. Okay? Central Securities Depository is just like the name implies, is a legal entity, it's an institution that keeps track of who owns the shares in Apple, in Tesla, and so on and so forth. Okay? So instead of the shareholder registry being kept by the company, and then maybe JP Morgan is a huge shareholder, but it's understood that JP Morgan is holding this in custody for some clients, instead of having this setup, there would be this setup, where the company would have a very simple shareholder registry saying, well, the shareholder registry is delegated to the CSD, and then the CSD would have this information. And now the CSD would have this information for each and every publicly listed company. Okay? And again, this is a natural monopoly, because if in the US there's really just one, it's called the DTC, forgot what it stands for, Depository Trust something, and they keep track of who owns which shares, and then when I say who owns which shares, it's just which bank or securities dealer own the shares. So in the CSD, it wouldn't show a Mr. and it would just show the JP Morgans, the Goldman Sachs, and the Morgan Stanleys, how much they own, because only they will be allowed to have an account with the CSD. Okay, again, it's kind of for convenience for the CSD not to have to deal with the retail clients. Okay, the CSD wants to deal just with big institutions, and there's reasons for that. And then JP Morgan or Interactive Brokers, they would all have an account directly with the CSD. And also, let's say you're with UBS and you want to move to Interactive Brokers, because it would be much cheaper for you to just keep those shares with Interactive Brokers. Then you would instruct UBS to send the money from their account. This would be an account of, say, JP Morgan with a CSD, to send it to the account of Interactive Brokers with the CSD. Okay, it's an actual account number. And you'll just instruct them to send them over with the correct message for further credit, Mr. So-and-so, so that Interactive Brokers knows that it goes into your account and didn't come from some of their other clients. Okay, then the CSD is connected to all of the exchanges. Often the CSD is owned by the same holding company as the exchange, and everything is kind of seamlessly connected. Now this is a huge natural monopoly, because which company, let's say I start a new CSD, and I try to attract the first publicly listed company to keep its records of ownership with me instead of with the existing monopoly. They're gonna think it's funny, and I'm never gonna do that, because they would firstly ask, well, do all of the major securities brokers, I bank with Interactive Brokers. Does Interactive Brokers have an account with you even? I say, well, not yet. So then I go to Interactive Brokers, try to sign them up, and they say, well, I'm not gonna bother opening an account with you, because do you have enough clients for me to have this additional financial infrastructure, this additional account, and then to integrate your IT system to my trading system? The answer is no. So it's a natural monopoly. The bigger you are, the more it makes sense for everyone to just use you. And in America, in fact, it's just one, and in Europe, there's two. And okay, so there's another huge monopoly in the ownership of shares. Okay. In my opinion, it's not as problematic as the monopoly that there is in bank deposits. But you can read about this. There's some additional information. Again, there's this trade, clear, settle cycle. Okay, on the exchange, and again, exchanges are again a natural monopoly. Okay, if there's if there's one big exchange, and I'm thinking I want to start a new exchange, well, and I'm going to try to convince the first investor to buy shares of Apple on my exchange and not on the main exchange. And then he's going to ask me, well, I want to buy shares of Apple. Do you even have Apple shares listed on your exchange? And then I'm going to say yes or no. It's a bit easier because all I need would be to have an account with a CSD, and then I can already allow this to trade. But then why would anyone buy or sell Apple shares on my exchange? Because maybe I've convinced one buyer and one seller, or a handful of buyers, a handful of sellers, to trade Apple shares on my exchange and not on the main exchange on the NASDAQ. But that means that the price, that the bid-ask spread would be so wide, maybe 1 or 2%, that no buyer or seller would want to buy or sell on my exchange, because if I'm a buyer, then I'd go to the NASDAQ because all the sellers are there. If I'm a seller, I would go to the NASDAQ because all the buyers are there. So, and this thing would reinforce itself. So exchanges are a natural monopoly, and the CSD is a natural monopoly, and the central bank is a natural monopoly. So the cycle of trade, clear, settle, again, is the same thing like we've discussed. First you trade, meaning you have an account with an exchange. And again, you cannot have an account directly with an exchange. You have to go through one of these securities dealers to open an account with them, and they have an account with an exchange. And then you click buy or sell, and if it's matched, because you know how a central limit order book works, it's like a two-way auction. The highest bidder wins, and the lowest price for selling wins. And then if there's a match, the price is the lowest seller is willing to sell, and the price that the highest bidder is willing to pay. If it's the same price, then they are matched. And then they are locked in legally to exchange it. But the actual exchange hasn't yet taken place. They just traded. And let's skip what clear is. A settle is after the information in the CSD actually reflected this. Okay, so if I was banking with Interactive Brokers, you were JP Morgan, you're the seller and I'm the buyer. Now the shares have been moved from JP Morgan to Interactive Brokers, and Interactive Brokers have updated that they are owned by me, not some other client, and cash has moved from my bank to your bank, and then that's settlement. In between, you have to remember that there is a risk that we've traded, but I don't actually have the money, or that you don't actually have the shares, and then you wouldn't deliver the shares, or I wouldn't deliver the cash, and that would be a problem. That would be non-payment. Then clearing is any one of a host of methodologies, of setups to make sure that there is no event of non-payment. And this actually involves some credit risk, and that's the main reason why only large financial institutions are allowed to have an account with the CSD and allowed to have an account with the exchange. Often the exchange owns the CSD. Okay? Any question here? Yeah.
So from where to where moves the hard cash if I sell you my shares? And we have different brokers or different symbols.
So let's talk about the soft cash, like a bank deposit. Yeah, so if you sold me Berkshire Hathaway shares, you were banking with JP Morgan, and I was banking, let's say this was Interactive Brokers. So after we traded and after it settled, here would have not a million but 99, and here would be not zero, it would be 1. Okay? And Interactive Brokers owns this in custody for me, and JP Morgan used to own it in custody for you. And then the cash would move commensurately from a bank account under the name of Interactive Brokers because they don't have a banking license. So from their bank it would move to JP Morgan, your bank. And it would contain the right message such that JP Morgan knows to credit it further to your sub account with them. But the cash movement would be settled in the central bank book. Okay? That's how it's just like the white and black stones. They never really leave the island, they never really leave the junkyard where they're stationed, right? Just the name changes.
So where stays the paper of the shares?
The shares don't have to have a paper. Most shares don't have paper attached to them. There is no paper. All the shares, they have no
Only the
paper.
beer shares.
Bearer shares.
Bearer
Bearer shares, they don't exist mostly. Apple doesn't have any bearer shares. So, and you have to understand that even a piece of paper is, you know, you can really feel it. It's physical, but this is of the same. It's as abstract as a ledger, as an accounting ledger entry, right? It's just information. The fact that it's paper doesn't mean anything.
So on the exam, if you ask us to build a T-bill, I give you my shares, so we never have to write down the shares in the balance sheets, only the cash moving.
Right, it's not gonna be on balance sheet, but I'm still gonna ask you to show a T-bill of the off-balance sheet information of who owns what. I hope that's understood. So when you look at the financial report, when you open the 600-page financial report of a bank, there is maybe 2 trillion, look at Credit Suisse, look at UBS, they have maybe $3 trillion worth of securities that they hold on behalf of clients. Okay, but their balance sheet is only $1 trillion. So where are the extra 3 trillion? It should be that they have 4 trillion liabilities and 4 trillion assets. But actually they show only the part of the liability which is actually a loan, like the bank deposit or the bonds that they've issued. These are actual liabilities, but the one that is purely custodial relationship, and that's held off balance sheet, and you would see that in the small notes at the end of it. But okay, but I'm going to ask you to put the T-bill that usually appears in the small notes. So I'm hearing sounds like everything is over. Let me just show you this. So long-term returns, including dividends. Yeah, you would have lost money here. You would have lost money here. But this is just equities. 2 classes from now, I'm going to show you how the long-term charts of balanced portfolio containing equities and bonds look like. And then these periods of losses are a lot muter. It's a much more stable kind of payoff. And that would be useful to you. All right, hope you had fun.